Most people know that compound interest builds wealth over time, but there is a second kind of compounding that almost nobody talks about that destroys it just as reliably. And it's not debt, and it's not bad investments. It's the cost of looking like you belong in the income bracket you're in. And the math on that second compounding is the reason most people earning a decent income feel like they should be wealthier by now and aren't. And once you see the mechanism clearly, you will never look at a purchase the same way again. And before we get into the why, there's a story worth starting with. Thomas Stanley and William Danko spent 20 years studying how actual millionaires in America behave. Not how they appear, how they actually behave. And what they found shattered every assumption about what wealthy people look like. The median price millionaires pay for their car is $31,367. Not a luxury vehicle, a reliable midsize. And 61% of people earning over $250,000 a year drive a Honda, Toyota, or Ford. Not a BMW, not a Mercedes. And then here's the number that lands differently. 8% of people earning under $100,000 a year own luxury vehicles, meaning a meaningful percentage of people who cannot comfortably afford the car they're driving are driving it anyway. One group looks wealthy. The other group actually is wealthy. And these are rarely the same people. So here's the mechanism, and this is the thing none of the videos on this topic ever explain directly. When you spend money to look like your income, you're not just spending the money, you're spending every dollar that money would have become. And that distinction matters more than any budget tip you've ever received. Because here's how it actually works. If someone earning $80,000 a year spends $25,000 of it maintaining the appearance of earning $80,000 a year, the newer car, the upgraded apartment, the wardrobe that matches the job title, they're not just spending $25,000. They're spending $25,000 plus 30 years of what that $25,000 would have compounded into. And that second number is enormous. Every dollar you spend looking wealthy is a dollar that can't compound into being wealthy. And that mechanism runs quietly in the background of every lifestyle upgrade you've ever made. Now, there's a name for the trap that makes this so hard to stop, and it's called the Diderot effect. And it comes from an 18th century French philosopher named Denis Diderot, who was gifted a beautiful scarlet dressing gown and within a year had gone into debt. Not because the gown was expensive, but because once he had it, everything else he owned looked wrong by comparison. So he replaced his desk, his chair, his art, his rugs, each item upgraded to match the one above it. And he called this phenomenon the regret of objects, the way one elevated purchase makes everything adjacent to it feel inadequate. And this is exactly what happens when you upgrade your car. Suddenly, the apartment doesn't match the car. And when you upgrade the apartment, the wardrobe doesn't match the apartment. And when you upgrade the wardrobe, the watch doesn't match the wardrobe. And every upgrade is logical on its own, and every upgrade together is quietly consuming your financial future one matching item at a time. But here's what the Diderot effect actually does to your financial life, beyond just spending more money. It locks you in. And this is the mechanism that most personal finance content completely misses. Every lifestyle upgrade you make raises the minimum monthly cost of your life. And the higher that floor gets, the less you can afford to lose, which means the less risk you can take, which means the less negotiating power you have in every professional situation you'll ever face. Someone whose monthly obligations are $4,000 can walk away from a bad job. Someone whose monthly obligations are $8,000 cannot. And that second person might be earning more, but they are categorically less free. And freedom is the thing that income was supposed to buy. If the cost of the appearance trap just landed in a new way, the like button is right there. It takes 2 seconds and it means the next video gets made. So here's what looking poor actually buys. And it is not what most videos say it is. Most videos say looking poor saves you money. And that's true, but it's the least important thing it does. What looking poor actually buys is options. And the word options is doing a lot of work in that sentence. An option is the ability to choose differently, to walk away, to take a risk, to say no, to say yes when everyone else can't. And options are the thing that wealthy people have that appears wealthy people don't. Because the appears wealthy person has converted their options into objects. They made the objects visible and the options invisible. And that trade is the most expensive trade most people never notice they're making. And the social dynamics of visible wealth compound this problem in ways that never show up on the budget. When you look wealthy, people assume you can afford to pay more. The contractor gives you a different quote when they drive into a wealthy-looking neighborhood. The car dealer treats you differently when you arrive in a luxury vehicle versus a Civic. The vendor adjusts their pricing based on what you appear to be able to pay. Warren Buffett noted that he never worried about being overcharged because nobody knew he was wealthy. And that negotiating advantage is invisible in the abstract and enormous over a lifetime of transactions. There is also a specific kind of freedom that invisible wealth creates in your relationships. Research from The Millionaire Next Door found that when children know there's a financial safety net, they build less urgently. They accumulate less on their own. They wait for the net instead of building their own. The quietly wealthy parents' children develop self-reliance because they don't know there's anything to wait for. And the last thing invisible wealth buys is something researchers have actually studied, which is that the growing net worth creates a constant background sense of security that doesn't adapt away. The BMW delivers a thrill for 3 weeks and then becomes the baseline, and you need the next thing. But the growing account balance provides a kind of ambient calm that compounds rather than fades. Because what you're feeling is not the purchase, it's the options. And options don't get boring. And I need the like button on the options insight because I rewrote that section 4 times before it said exactly what I meant, and I would like some evidence that version 4 was the right one. So here's the part that explains why all of this is so hard. And this is the thing that makes looking poor not just a financial strategy, but a psychological one. The research on this is from Thomas Stanley's decades of studying actual wealth. And he found that the single most consistent predictor of whether someone builds wealth is not their income. It's the ratio between their income and their expenses. And he created a framework to measure it. People who build wealth above what their income would predict, he called prodigious accumulators of wealth. And people who accumulate below what their income would predict, he called underaccumulators. And the underaccumulators almost always have one thing in common. They live in high-consumption environments, affluent neighborhoods where the visual baseline for what a financially successful person looks like is calibrated at a price they can technically afford but can't actually afford to keep compounding simultaneously. And here's the sentence that unlocks all of it. The underaccumulators haven't made bad financial decisions. They've made good social decisions. They've correctly figured out what success looks like in their environment, and they've correctly acquired the visual signals of that success. The problem is that visual success and actual wealth are not just different things, they actively compete for the same dollar. And that is the mechanism. Not a moral failing, not a lack of discipline, a direct dollar-for-dollar competition between looking wealthy and becoming wealthy. And you can win one or you can win the other, but you cannot win both at the same pace. And the people who actually build the most wealth in any income bracket have simply decided which competition matters to them. Most people earning a decent income in 2026 feel like they should have more to show for it by now. And the honest answer to that feeling is not that they need to earn more. It's that the dollar they spent last month on the appearance of their financial life canceled a dollar that would have become $2 or $3 or $10 in the version of their life where they chose differently. And that's the whole thing. Looking poor isn't a sacrifice, it's a decision about which competition you want to win. I make these videos because I find it personally frustrating that the most powerful financial strategy available to working Americans is also the one that gets the least airtime, because it doesn't feel like advice, it feels like giving something up. Subscribe so I can keep being frustrated about that on your behalf. The video on your screen right now might be more helpful for you, so click and watch.